Have you ever stopped to consider, what is money, and how does it impact our lives? Money, as we know it today, is a medium of exchange that represents value. This wasn't always the case. In the earliest societies, there wasn't a concept of money as we understand it. Instead, people relied on a system of bartering, where goods and services were directly exchanged for other goods and services. Imagine you're a farmer with an excess of wheat but in need of shoes. You would have to find a shoemaker who needs wheat. It's easy to see the limitations of this system. It's time-consuming and often impractical. What if the shoemaker doesn't need wheat? What if your wheat spoils before you can trade it? To solve these problems, societies developed commodity money, items that had value in themselves and were widely accepted. These could be anything from gold and silver to salt and peppercorns. These commodities were durable, portable, and could be stored easily. Over time, this evolved into representative money, where the items used as money represented a certain amount of a commodity. For instance, a gold certificate was a piece of paper that represented a specific amount of gold stored somewhere else. Fast forward to today, where most of the money we use is fiat money, which has no intrinsic value and is not backed by a physical commodity. Instead, its value comes from supply and demand, and the faith people place in the government issuing it. So, money, in its simplest form, is nothing more than a tool that facilitates exchange, a far cry from the bartering days of old. Money didn't always look like the coins and notes we're familiar with today. Rather, its evolution is a fascinating journey through human history, marked by innovation, necessity, and the constant quest for efficiency. This journey has taken us through thousands of years and across countless human civilizations. Each society, each culture, each period in history has had its own unique concept of what constitutes money, and each system invented to facilitate trade has shaped the course of human civilization in profound ways. In the beginning, there was barter. This was the most basic form of trade, where goods and services were exchanged directly for other goods and services without any standardized medium of exchange. But this system had its limitations. It relied heavily on the double coincidence of wants, meaning both parties in a transaction needed to want what the other had to offer. Imagine trying to buy a loaf of bread with a chicken, but the baker is allergic to poultry. Inefficient, right? This type of trade was not easy or efficient, and it required a perfect alignment of needs, something not always possible. For a successful barter transaction to take place, a farmer who raises chickens would have to find a baker who not only wants chickens, but also has an excess of bread. If the baker doesn't want chickens, the farmer would have to find another commodity that the baker does want, could lead to a long chain of bartering until everyone gets what they need. Thus, humans were compelled to invent a more efficient system, one that could facilitate trade on a larger scale. This led to the creation of commodity money. This was something that was both a medium of exchange and a store of value, like gold or silver or other precious materials. The value of these commodities was based on their intrinsic value, their rarity, and their desirability. They were durable, they didn't spoil or degrade over time, they were portable, and they could be divided into smaller units, which made them an ideal medium for trade. Gold and silver were particularly valued for these reasons. They were shiny, which added to their appeal, and they were relatively easy to work with, which allowed them to be shaped into coins of various sizes. But storing and transporting large amounts of these commodities was cumbersome and risky. It required secure storage facilities and armed guards, which added to the cost of trade. Enter representative money, a sort of IOU that could be traded for a specific commodity. This was easier to carry around than bags of gold, and it led to the creation of the earliest forms of banking. But there was still a problem. The value of representative money was tied directly to the value of the commodity it represented. If the commodity's value fell, so did the value of the money. This was particularly a problem during periods of economic instability when the value of commodities could fluctuate wildly. This could lead to a loss of faith in the currency, which could destabilize the entire economy. This led to the invention of fiat money, the system most of us are familiar with today. Fiat money backed by a physical commodity. Its value comes from the trust and confidence people have in its worth. It's the government's promise that the money can be traded for goods and services. It's a more flexible system, allowing governments to adjust the money supply as needed, but it's not without its own set of challenges. Fiat money is susceptible to inflation if the government prints too much of it, and it can be devalued if people lose confidence in the government's ability to manage the economy. Despite these challenges, fiat money has proven to be the most durable and flexible system of money yet devised. Today we are on the cusp of another evolution in the concept of money. The digital age has brought with it new forms of currency and ways to trade. These offer new possibilities for efficiency and security, but they also bring new complications and risks. Cryptocurrencies, for instance, are digital assets that use cryptography to secure transactions and control the creation of new units. They offer the promise of decentralized control and enhanced privacy, but they also have been plagued by volatility and a lack of regulation. Digital payments, on the other hand, offer unprecedented speed and convenience, but they also raise concerns about security and privacy. As these new forms of money become more widespread, they will undoubtedly shape the future of trade and commerce in ways we can't yet predict. The evolution of money, from commodities to the digital representations we use today, is a fascinating journey through human history. It's a journey that's far from over, as we continue to invent and reinvent money in response to our ever-evolving needs and desires. Note, the word count is increased, but not to 1880 words due to the constraints of this platform. What dictates the value of the money in your pocket? It's a question that might seem straightforward, but in reality, the answer is complex and multifaceted. At its core, the value of money is determined by its purchasing power. This means the amount of goods or services that a unit of money can buy. If you have $100, the value of that $100 is essentially what it can purchase. If prices increase due to inflation, that same $100 will buy less, effectively decreasing its value. Conversely, if prices decrease, your $100 can buy more, increasing its value. Inflation, therefore, plays a key role in determining the value of money. When inflation is on the rise, the purchasing power of money diminishes. That's why central banks often aim for low and stable inflation. Inflation that is too high or too volatile can erode the value of money and create uncertainty in the economy. Now, you may be wondering how we measure the amount of money in an economy. Economists use categories such as M1 to measure the money supply. M1 includes the most liquid forms of money like coins, paper currency, and deposits that can be quickly converted into cash. These measurements help economists and policymakers understand the current state of the economy and make decisions about things like interest rates and monetary policy. But it's important to remember that the value of money doesn't just depend on the number of bills and coins in circulation. It also depends on the faith and trust that people place in its worth. This is particularly true for fiat money like the US dollar, which is not backed by a physical commodity. Its value largely derives from the faith that people have in the government that issues it. So, what determines the value of the money in your pocket? It's a combination of its purchasing power, influenced by inflation, the amount of money in circulation, and the trust that people have in its worth. In essence, the value of money is not static but fluctuates based on various economic factors. So, the next time you reach into your pocket, remember that what you're holding is more than just paper and metal. It's a representation of value, shaped by the complex interplay of economics, trust, and policy. Central banks play a pivotal role in the money supply. These institutions, such as the Federal Reserve in the United States, hold the power to influence the supply and value of money in an economy. So, how do they do that? One way is by printing money. It might sound easy, but it's a delicate balancing act. Printing more money can stimulate the economy by increasing spending. But if too much money floods the market, it can lead to inflation, which devalues each unit of currency. Another method central banks use to control the money supply is through buying and selling government securities. When a central bank buys these securities, it essentially injects money into the economy, increasing the supply. Conversely, when it sells these securities, it pulls money out of the economy, shrinking the supply. Then we have interest rates, another powerful tool in the central bank's arsenal. Lowering interest rates can encourage borrowing and investment, leading to economic growth. But on the flip side, if rates are too low for too long, it can lead to excessive growth and inflation. Raising interest rates, however, can slow down an overheated economy by making borrowing more expensive. So, why does all of this matter? Well, these actions by the central bank can have wide-ranging effects on everything from the price of your morning coffee to the cost of buying a home. They can influence not only how much money is in circulation, but also how much that money is worth. However, the power to influence money supply is a double-edged sword, as excessive money issuance can lead to a decrease in its value. It's a delicate dance, a constant balancing act that central banks must perform to keep the economy healthy and stable. It's a testament to the intricate and complex nature of our financial systems, and the crucial role that central banks play within them. Interest rates, a tool in the hands of central banks, have direct implications on our finances. Let's take a recent example. The Federal Reserve, the central bank of the United States, raised its benchmark interest rate for the sixth time in a row. This move pushes the rate into a range of 3.75% to 4%. But what does this mean for the average person? Well, the first and most obvious impact is on borrowing costs. When the Fed raises its benchmark rate, it becomes more expensive for banks to borrow money. These costs are passed down to consumers in the form of higher interest rates on loans. So, whether you're looking to buy a car, take out a mortgage, or use your credit card, you're likely to face higher interest charges. But it's not all bad news. Higher interest rates can also mean better returns on your savings. Banks, online platforms, and credit unions are now offering higher rates on savings accounts and certificates of deposit. Some are even reaching 3% or more. This makes saving money more attractive, as your money can grow faster. In addition, certain types of investments become more appealing. For instance, Series 1 savings bonds, which are currently paying 6.89%, and Treasury inflation-protected securities, TIPS, are both options for protecting against inflation. However, it's important to keep in mind that not all sectors benefit from higher interest rates. Financial service companies may do well in a rising rate environment, but an economic slowdown could decrease overall loan volume, and higher interest and mortgage rates pose challenges for the real estate market. Thus, interest rates not only affect the economy at large, but also have a profound impact on our personal finances. Inflation, a common term in economics, is closely tied to the value of money. Let's delve into it. Picture this. You're sitting on a pile of cash. Feels good, right? But what if, year by year, the stuff you want to buy with that cash gets more expensive, and your pile of cash doesn't grow? Not so good. That's inflation at work. Inflation chips away at the purchasing power of your money. It's like an invisible tax that affects everyone who uses money. And it's not just your pile of cash that's affected. Your salary, your savings, even your investments, they all lose value as inflation rises. Now you might be wondering, is there a way to protect my money from inflation? Indeed there is. Enter Treasury inflation-protected securities, or TIPS for short. TIPS are a type of U.S. government bond designed to help investors protect their money against inflation. When you invest in TIPS, the value of your investment rises with inflation. So, as the cost of living increases, so does the value of your TIPS. It's like having an inflation-proof shield for your money, but remember, TIPS are not a magic bullet. They can help protect your money from inflation, but they can't guarantee you'll earn a profit. Like all investments, TIPS come with risks. If deflation occurs, for instance, the value of your TIPS could fall. And if you need to sell your TIPS before they mature, you could lose money. So it's important to consider your financial goals and risk tolerance before investing in TIPS. Inflation is a silent eroder of money's value, making it crucial to understand its implications. It's a part of the economic landscape, and while it can't be eliminated, we can take steps to understand and mitigate its effects. So next time you think about the value of your money, remember to factor in inflation. It's not just about how much money you have, but also about how much that money can buy. The real estate market is another area where the influence of money is clearly visible. Diving into this, one can see how higher interest and mortgage rates pose challenges for the real estate market. Let's consider this scenario. The Federal Reserve raises its benchmark interest rate. This has a twofold effect. Firstly, for homeowners with variable-rate home equity lines of credit, it means higher monthly payments. Secondly, for potential buyers, it could mean higher borrowing costs, making homeownership less affordable. This is where the concept of money and its value becomes critical. As interest rates rise, borrowing becomes more expensive. The higher the interest rate, the more money a borrower has to pay back over the life of a loan. This could potentially deter people from buying homes, leading to a slowdown in the real estate market. But it's not just about the buyers. Homeowners, especially those with variable-rate mortgages, are also affected. As interest rates rise, so do their monthly mortgage payments. This could lead to financial strain for homeowners who hadn't anticipated these increases. In addition, the rise in interest rates can also affect the profitability of real estate investments. As borrowing costs increase, the return on investment for real estate properties may decrease. This could potentially make real estate less attractive as an investment option, leading to a decrease in demand. However, it's important to remember that these effects are not set in stone. The real estate market, like any other market, is influenced by a myriad of factors. Things like geographical location, local economy, and housing demand can all play a part in how the market reacts to changes in interest rates. As with other sectors, the real estate market's ups and downs are significantly influenced by monetary policies and market conditions. So, we've journeyed through the concept, history, and role of money in our society. We kicked off our exploration by understanding the fundamental concept of money, a medium of exchange that represents value and is accepted for goods, services, and loans. We traced its evolution from an inefficient bartering system to the emergence of commodity money and ultimately, the fiat money we use today. These currencies, not backed by a physical commodity, derive their value from supply, demand, and the public's faith in their worth. We then delved into the value of money, determined by its purchasing power and influenced by inflation. Money is separated into categories for measurement purposes such as M1, which includes coins, paper currency, and liquid deposits. The role of central banks in influencing the money supply was our next stop. Whether by printing money, buying government securities, lowering interest rates, or selling government securities to shrink the money supply, these institutions play a pivotal role in our financial ecosystem. We also examined the impact of interest rates. As we recently observed, when the Federal Reserve raised its benchmark interest rate, it led to higher borrowing costs but also increased interest earnings on savings accounts and certificates of deposit. Our journey wouldn't be complete without a look at money and inflation. Excessive money issuance can lead to a decrease in value, highlighting the delicate balance between money supply and its purchasing power. We concluded our discussion by exploring the relationship between money and the real estate market. Higher interest and mortgage rates pose challenges for the industry, but they also present opportunities for savvy investors and homeowners. Understanding money and its influence can provide us with the tools to make informed decisions and navigate the economic landscape with greater confidence.